Apple Incorporated, the world's largest technology company, reported their Q3 2023 earnings results on August 3. Revenue came in at $81.8 billion, down 1.4% year-over-year, with gross margins slightly better to 44.5%. Their revenue by division showed that their iPhone product, whose sales make up nearly half of their total, was $39.7 billion, down 2.4%. Their Mac personal computers posted $6.8 billion, down 7.3%. iPad at $5.8 billion was down 20% year-over-year. The wearable and home accessory business was better to $8.3 billion, up 2.5%. The services segment was $21.2 billion, up 8%. Back to the earnings highlights. Operating income stood at $23 billion, or about 28% of total revenue. Pre-tax income was nearly the same at $22.7 billion, both slightly down year-over-year. Their bottom line was $19.9 billion, up 2.26% year-over-year, suggesting their tax provision was lower, and in fact it was lower by $800 million. This was why Apple showed that 2% growth. The enterprise value stands at $2.875 trillion at the time of this report. Turning now to the per-share ratio data, we can see that shares outstanding declined by almost 500 million, or 3%. This gave the earning per share a boost to $1.26, up 5% year-over-year. Sales per share came in at 5.2 times, slightly higher. Cash per share stood at $1.85, up 24%. The increase was partially due to the sale of marketable securities, which are reflected in the investing cash flows we will review in a minute. Book value was better by 22% to $3.82. Annualized PE is 35 compared to 25.79 on the S&P 500. PE growth was 6.65. Leverage ratios show the debt ratio slightly worse to 0.29. Long-term debt decreased by almost $1 billion, but total assets were down by $17 billion. Debt to equity improved by 16% to 1.63 as shareholder equity increased. Interest coverage at 86.8 times is more than adequately covered. Short-term liquidity ratio are also positive, with the current ratio improving to 0.98 and the quick ratio to 0.66. The cash ratio also improved to 0.23 due to the sale of marketable securities previously mentioned. Return on assets was 24%, up slightly, but return on equity was down to an impressive 132% annualized. The equity multiplier at 5.56 showed just how much the company uses debt to run the business. The cash flow of the company remains strong. Operating cash flow was $89 billion, up 9%. Investing cash flow was positive at $1.1 billion, reflecting that sale of marketable securities. Financing cash outflows were slightly worse to negative $85 billion, with a total free cash flow to the firm of $30 billion. The company declared a 24-cent dividend, producing an annual yield of 0.5%.